All right. How do we differentiate between merchandising business and service businesses? That's where this chapter or this video comes into play. We're going to talk about how do we actually recognize these things? What do they look like in a journal entry? Now, pretty much from here on out, I'm going to make the assumption that you know how to convert journal entries into T-tables because it's pretty straightforward. If you haven't, go back to chapter, I believe, 2 and rewatch those videos. For right now, I'm just going to, when I move forward, it's really going to be on these examples, just the journal entry, because that's really where you need to know that. Hopefully, you know how to turn them into T-tables. So, how do we recognize the events that happen typically in a merchandising business? Well, let's talk about the first, the obvious one, and that is how do we recognize us buying the inventory or purchasing the inventory? So, we, the company, purchase inventory. We bring in the inventory into our business in order to sell. So we're just looking at that point first, bringing it in. Okay, so what would that look like on a journal entry? Well, whatever the date is, I'm just going to put 1/1. And I'm going to put merchandise inventory or inventory of whatever amount. That's what I'm debiting because remember, that is an asset account. I own that inventory until I sell it. So my inventory is going up by that amount. And then I'm going to credit however I pay for that inventory. Maybe it's cash, maybe it's accounts payable. It should be payable. I'm not sure why it says accounts receivable, but accounts payable because it's a liability to us if I go that route. So that is what just the simple purchase of inventory journal entry would look like. Very straightforward. My inventory goes up, my cash or my AP goes, or my cash goes down, or my AP goes up, my liability goes up. It's a lot of moving pieces to this. But that's the purchase. Now let's look at the sell. The sell is where the difference happens. The sell is where you're going to see a major difference here. Okay. So when we sell inventory, there are a couple things that's happening. So each sell involves two things, two parts, and therefore require two entries. Okay. And each entry will have its own debit and its own credit at minimum. So we're really talking about a minimum of 4 accounts being affected here. Okay. The first thing we need to recognize is the recognition of the revenue. We sold inventory. We gave the product or service, therefore we got inventory, or we got revenue. Okay, that's the first part. So let's go ahead and do the journal entry for that. My debit is going to be however I was paid. So it's either going to be cash or it's going to be accounts receivable. That one's right. Of however much. Okay, so however much I sold it for, that's what I got in cash. My cash went up or my AR went up, whichever one they paid with. Okay. That's also the amount that I earned. So my credit is going to be sales revenue, or sometimes you'll just see it called sales. That's part 1. That's step 1 of the sales of inventory. The second step is now we have to recognize the expense side of it, or what we call the cost of goods sold. Okay. Remember, we purchased this inventory with the intent to sell, which means we're not going to use it. Remember, we don't expense things until we use it. We're not going to use it until we actually do sell it. And at that point, we have used the inventory for what its purpose was. So therefore, not only do we have to recognize revenue, we have to expense it as well. So the second step of this is going to be the expense side, and we use what's called cost of goods sold. You can kind of think of it as inventory expense, but we use the term cost of goods sold as a account name. So the second part of this will be I'm going to debit my expense account, which is cost of goods sold. So cost of goods sold for whatever that amount was to me, not what I sold it for, but what it cost me. And then not only did I gain something, I gained cash, I also lost the inventory because I gave it to my customer. So my credit for this one would be merchandise inventory or inventory for the same amount. It is important that you recognize the different numbers because the cash and the sales revenue are what we sold it for, and the COGS or cost of goods sold and the inventory is what it cost us. You don't want to have the same numbers on there because that means you're not making a profit, and that's a very bad business strategy. You will go out of business very quickly. Okay, that's it in concept. If you want it in more practical sense, I would just, like we've been doing from the beginning when we talk about journal entries, we do all the debits first and all the credits last. This is what a more practical one would look like. I do my 2 debits together, and then I do my 2 credits together. Still the same thing most of the time. It's not that big a deal. But that is how you recognize the purchases and the sales of inventory. Appreciate it.